Hi, my name's Thadd Welch. I'm a portfolio manager here at St. Germain Investments, and I'm going to be talking a little bit about China today. China has experienced tremendous growth over the past couple decades, and today they're the largest economy, or the second largest economy in the world, and they're starting to slow down. So what we really saw throughout starting in 2000 or so, was a government orchestrated effort to really build out their infrastructure and their cities. It was basically an industrial revolution, and through that process they actually ended up consuming a lot of the world's commodities and other goods, but that is starting to slow down now. If we look at the first chart, you can just see where their GDP was exceeding at one point in time over 14%. Since then, it has started to trend down. This hasn't been a secret. That's one of the things in the news you hear about China slowing just over the past couple of years, but this has really been progressing for 7 years now. If you look at just the red arrows, where they've come since the financial recession, gradually trending down. They're still growing at about a 6.5% rate, which really is still enviable on the global scale, but for China, coming from 14%, that's a pretty significant slowdown. So what's really happening there is that they're transitioning away from the industrial revolution, and they're trying to become a more mature economy and look more like the USA and Europe. And in that process, it takes time to move away from the government facilitating everything to the service sector taking over, and that's really what drives the United States and Europe. Is about 75% of our GDP is geared towards services, whereas in China it's about close to 50%, and that's made some tremendous progress. Looking at the second chart here, from where they were, say, back in the 80s, which was closer to only 20% of their GDP. So really progressing upwards. That needs to continue to drive higher if they want to become, a fully developed nation, very mature, and get away from the dependency of the government. But because of this slowdown, and because they consume so many commodities, it's having reverberating effects on the rest of the world, particularly other emerging markets. So if we look at the third chart here, and take a look at the blue line, which is exports from other emerging markets to China, and you can see how it's dramatically dropped off over the past few years. And it's primarily because the commodity prices have dropped off so much, because China no longer needs to use as much coal, as much aluminum or iron ore that they had before, when they were just building out all of their infrastructure. And now they really want it to be much more consumer driven. So some of these emerging markets that are very dependent on their resources and don't really have a very mature economy themselves, they can no longer just export their goods to China and expect to make profits off of it. But the good news is that China has a lot of firepower, and their government is willing and able to do what it takes to kind of facilitate this transition from the industrial to the consumer. We saw that over the last year, where their government cut their reserve requirement ratio, which is something that the banks are required to hold an amount of capital for every deposit before they can actually loan it out, and they keep cutting that rate so that the banks can loan more money, and they did that 5 times just over the last year. And then looking at their stock market, which had a big roller coaster last year, big boom and bust, the government intervened with stimulus packages that amounted to $1.3 trillion. And just to put that into perspective, when we had the worst financial recession here in the United States, the largest economy in the world, one of the largest financial institutions in the world, we only pumped $700 million into our financial recession, but yet the government in China just put $1.3 trillion in, almost twice as much as the United States, just last year, just to support their stock market, which was going through a roller coaster. So we know that they're willing to do what it takes to facilitate the transition and to prevent what's being called a hard landing and go for the soft landing. In the meantime, really the only thing we should expect is volatility, because it's going to be a bumpy ride as they try to juice up the service side and the consumer side of their economy.